Hello, everyone. Don Garman here, Mirador Capital Partners. Here we are again. We are in July. We are more than halfway through 2024. And I wanted to update you with some of my thoughts, which are changing. And the risk I run in this video is that some of the things I say might seem contradictory, which in some sense they are, and in other senses they're not. So I'll explain. And I'm also going to add a few charts, and hopefully they can at least illuminate visually some of the things I'm trying to describe. So, first half of the year was, I would say, uh, unexpectedly pleasant on the index line, powered really by one theme, which is that ever-present AI, artificial intelligence boom that we know is going to translate into capital expenditure, really with a couple of different companies, and is going to usher in, by all estimates, a new wave, a new era, similar to what the internet did back in '99, of computing, and a new way of doing things in different architectures and different ways that companies will do business. And I don't doubt that it's going to be incredible in nearly every dimension. But now, like then, things, I guess the cliche is trees don't grow to the sky. And so what I want to describe is a condition where we sit in July 2024 with the lowest volatility in an election year at this point in the year ever. So I think it's reasonable to expect volatility, the moves, the noise, the amplitude of the daily moves should and will likely increase, which can be pleasant on good days and unpleasant on bad days. I want to reiterate, our emphasis is on consistency of returns rather than higher average returns. And so many of you have seen me describe why this is important in compounding, that you avoid large down periods. That will always be true. And particularly for our clients, consistency matters over higher average. This is how I've proven many, many times that 10 is in fact larger than 12 and a half when you draw the sequence of returns and how you end up with more money with a lower return if it's more consistent. Many of you have lived this for 3 decades now. So the parallel to 1999 is that while the indexes and most indexers rely on these 3 or 5 really companies to continue to produce returns for them to have returns, we don't have that condition. What we were able to do in the last time the markets were like this, which was 24 years ago, is we made money in 2000 and 2001 and just down a little in 2002, when that was 3 years of negative returns on the index level. And in reality, a decade of flat returns. It's called the lost decade, 2000 to 2010. We didn't have a lost decade. So why I'm more optimistic than I have been at points is because the 495 companies in the S&P 500 below the top 5, which produce and have been responsible for the vast majority of returns, their future earnings expectations are starting to edge up ahead of the top 5. So if you think the math of it through, the tidal wave change of AI and compute and data centers have put the arms race into the hands of a few winners in this period. And eventually, the market will shift. And I'll explain when I think that could be. I will talk more about this in the months ahead. So I'm going to shift to talking about a parallel between individuals and corporations in this current era, the last 3 years, let's say, 2.5 years. when the Federal Reserve made the decision that they were behind on inflation and took interest rates from 0 to 5, I'm simplifying to make this point, inflation itself and the interest rate move hurt a broad section of the consumer and families and let's call it households in general, and then small cap companies, which are, all companies are sort of the equivalent to the households. So lower income households were hurt, equivalent to small cap companies, and the strongest consumers, in which many of you are included, were helped because what loans we had were fixed in 2021. Our interest rates didn't go up, but what we got in return for the cash we were holding, which had been 0 for 15 years, went up a ton. So this to me explains what's going on in the economy and in travel spend and in people's willingness to spend. Many households have this newfound return in their cash portion that they didn't have before. Feels like found money. Large companies have the same thing. The money that they have issued in bonds are low interest rate loans. They're getting 5% on their huge mountains of cash as well. So where I think this all pivots is when the Fed does start to lower rates, and that could be coming, maybe one this year, who knows? I don't necessarily predict or care, but when the Fed does start lowering rates, then my hunch is that would be the cue of the market to shift the narrative back out of the S&P 5 and into the 495, which ultimately the name of the game is buying $1 worth of assets that's growing at the fastest rate you can find for the cheapest price you can. That's what investing is. So there will be a move coming, and the charts I'm going to show are S&P 500 versus small cap and growth versus value. Both of those relationships are near the most stretched they've ever been. And one of the most powerful forces of financial theory is reversion to the mean. It's not a theory. It is based in sort of a law of gravity, or there are reasons for it. So I've managed to complicate this enough. I'll throw a couple of charts in. Earnings estimates, as we talk about all the time, are very stable, but importantly, the ones below the top 5 are starting to make up some of the difference in rate versus the top 5. That's very important for us. And I think this is going to be something I'll be talking about for month after month after month for a little while. So thanks for staying with us. And sorry if that was a little technical. Hope you are enjoying your summer. And as always, we appreciate you and the trust you put in us. And if there's anything further we could do, please reach out. And until next month or sooner, perhaps, we will see you then. Thanks. Bye.